Hello, and welcome to today's special event about the truth behind investing, the secrets that experts do not want you to know. I am really glad that you're here with me, and I promise you this: by the end of this presentation, you will have a whole new perspective about investing, the right perspective. And again, thank you for your attention. Let's get started. What will we be covering today? We will start with a quick introduction. We will discuss the psychology of investing, what the pros really think about average cost down, and diversification. We are going to talk about the invisible game of banking and advisor's fees. And finally, we will get to the main reason you are here. Because I am going to show you how to really make your money work for you, investing it just like Warren Buffett invests his, doubling your money in a single bank transaction, and accelerating your retirement age from 65 to less than 35 by learning how to invest outside 401ks and IRAs. So, why are you here? You are here if you want to learn how to double your investing performance, how to go from 1 to 2, from 10 to 20. You are here today if you want out of the rat race, if you want to retire at 35 and not 65. And you are here, especially if you want to achieve your financial independence at a young age so you can start living a rich life. So, how are we going to achieve this? We are going to achieve it by creating a truly passive income portfolio based on the income of dividends, royalties, interest, and distributions. What is passive income? Passive income is not writing a book or owning a website. That is called residual income. Real passive income means receiving a dividend payment from, for example, PepsiCo, without having to produce, sell, or market its products. In fact, you do not even have to drink Pepsi yourself to receive the reward of investing in the company. So, imagine having a passive income portfolio working for you. What will this mean to you? How will it change your life? Will it mean more travel and vacations? Will it mean more free time with your family? Will this change and improve your lifestyle? Will this free you from that pesky alarm clock? Take a moment and reflect about this. Why should you listen to me? Because my investing performance, my track record, that is the real reason you should listen to my advice. On your screen, you can see a snapshot of the holdings inside my investment account. You can also see my market performance. It shows that I have beaten the market since the beginning of my investing career. I am not showing you this to impress you, but to impress upon you the importance of performance. Because people should not talk about investing unless they are willing to show you their actual holdings and performance. Now, who is this presentation not for? Before we continue, let me tell you that this investing course is not for speculators, people looking for a get rich quick scam. I am sorry, but this presentation is not for you. You may want to leave right now and enjoy the rest of your day. This is not for people with extreme amounts of consumer debt. This is not for non action takers, what Seth Godin called brain lizard persons, the famous entrepreneurs. Also, I have this weird belief that you should not listen to the advice of people who have less money than you have. So, if you have a positive cash net worth of more than $500,000, you are welcome to leave this presentation at any time. This presentation is for avid income investors, smart and educated people, action takers. That is because no amount of information in the world will help you improve your life if you are not willing to take drastic and bold action. Now, I hope that those of you who are still here with us today are ready to forever change your lives. I appreciate and value your time, and I expect you to do the same. So if you know that you are not qualified for this course, please do leave right now and have a beautiful day. Continue doing what you were doing. If you are happy with settling for less and not ready to start taking action, I understand. Becoming an avid and successful investor is not for everyone. But for those of you who are still here with me, what you are about to learn is the truth about how investment bankers really operate and how you can beat them at their own game. The first thing you need to know is that investing is more than an art and a science. What is really important is that sweet spot between them, the psychology, the mindset about investing. That is because, more than technicalities or fundamentals, the markets are driven by emotions. According to JP Morgan Asset Management, for the last 10 years, the market has moved in cycles of 50% corrections. What is really important to learn about the graph on your screen is that for us to come back from that 50% correction, we need to make a 100% gain just to break even. So, think about that before you make your next broad market index investment decision. Okay, you may ask yourself what these market cycles mean for you. The truth is that you yourself are your own worst enemy, and not knowing how to control your emotions and investing decisions can cost you more than 100% of the market gains, missing an easy double just by not knowing what to do. And when market uncertainties hit, the best thing you can do is to sit on your hands and do nothing. This underperformance is known as the behavior gap. Tell me if this sounds like you. Do you believe in buying low and selling high? That bleak tactic of average cost down. Do you believe that diversification is the best way to reduce your market risk exposure? What do you believe? Does this sound right to you? Do you invest this way? I am sorry, but this is a loser's mindset, a go broke strategy. The blunt truth is that professional investors, market makers, and investment bankers do not behave this way. This is what pros and legendary investors like Warren Buffett and Carl Icahn really believe and do. They believe that diversification is protection against ignorance, that average cost down and buying a declining price stock is like going in and catching a falling knife. If you are a long-time investor like I am, you surely have heard about the typical diversification concept of 30% bonds and 70% stocks. And by assuming an 8% return on your investment portfolio, you will never run out of money during your retirement. However, the practical reality of the markets, and according to JP Morgan Asset Management, this tactic fails to deliver the desired outcome. As you can see on this chart, this strategy has not worked over the last decade. Remember that theories are just that, theories, and they do not resemble reality. Now, imagine adding the average cost down technique to this fallacy. That will really mean game over for all of us. This strategy is even more popular today with the creation of age target mutual funds. But what bothers me the most is that even when this strategy does not work, we are still charged high and expensive fees, based solely on the illusion of winning the rat race. And, worst of all, you will have to wait until 65 to cash in. That is, if you are lucky enough to win. What is the point of saving now if we are not going to be young enough to enjoy ourselves and reap the rewards of all our hard work? Do you know that brokers are selling you the wrong idea about diversification? That is not how they really invested and diversified their own portfolios. Look how they manage their risk allocation on more than 15 different asset classes, not just stocks and bonds. Ask yourself this: how is your portfolio looking right now? According to UBS Wealth Management, the main difference between baby boomers and millennials is their risk tolerance. Millennials are holding more than 50% cash, while baby boomers hold almost twice as much in equities. However, no matter what your asset allocation is, this perspective of investing is wrong, and it will get you nowhere if you continue to behave this way. It is time for a change. The question now is: are professionals and retail investors beating the market? The answer is no. According to JP Morgan Asset Management, an average investor gets returns of only 2.5%, while the S&P 500 returns more than 900% on an annualized basis. If you look inside the portfolios of the professionals, you will see a diversified allocation ranging from 3 to 8 different market segments, not the typical two that they are selling us. Take a closer look at the following chart that shows the market's record performance over the past 10 years, and you can see that portfolio managers often do not beat the market. In fact, they underperform it. See how that so-called asset management allocation module does not outperform the S&P? The worst part about this underperformance is that they are still billing us high fees. According to the New York Times, mutual funds fees range above the 1% mark. Over a period of 10 years, this could cost you more than 29% of all your investment returns. These high fees are worse than paying tolls or taxes. Not only that, the compounding effect works on your investment expenses too. This could cost you around $500,000 on management fees over a period of 30 years, according to personalcapital.com. Beware of close indexing. Although it is true that we get what we pay for, and there are some excellent managers out there, such as JP Morgan, that can bring you higher returns at higher cost, but do remember that not all funds are created equal. In fact, in 2013, only 0.07% of all funds beat the market. Picking the right portfolio manager is often harder than picking individual stocks, as you might already know. Beating the markets is an insider's game. Michael Lewis tells us that investment bankers work for their banks, not their clients. Confessions of a Street Addict lets us know that paying high fees is the only way to afford relevant and timely information. From Taking a Random Walk Down Wall Street, we learn that market prices are impossible to predict and that you will have to invest for the rest of your lifetime to come out ahead, trapped inside the rat race. I do not know about you, but I refuse to have to wait until I am 65 to retire. Knowing this, do you think you can beat the market on your own? However, I must warn you to beware of the type of help you seek. You could end up paying even more than what you expected. Being a client of a recurring monthly fee services could mean you are paying fees on top of fees, double paying someone for the privilege of managing your hard-earned money. How much could you be paying? According to the Wall Street Journal, a low-fee managing service could be more expensive than it looks on the surface. That is because those fees on top of fees also have hidden costs. Go figure, right? Then again, not all solutions are created equal. Not knowing what you are doing and still doing it could cost you more than $60,000 over the lifetime of your portfolio. But hiring automated investment services like Betterment and Wealthfront can go for around $20,000 during the lifetime of your portfolio. Still, I believe there is a better way to invest without freezing all of your money for 30 years or more. Looking deeper at the investment solutions that are out there, we can see that their strategies are based on the typical definition of diversification, with not much success in producing average annual returns of around 7%. Even if we feel comfortable with the amount of risk we are willing to take, our returns can be all over the place, from sustaining losses to making a mere 4%. That is less than half of the average S&P returns that we discussed at the beginning of this presentation. So, what have we learned so far? 1. To come back from a 50% loss, we have to make a 100% gain. 2. We can be our own worst enemy. 3. Diversification and average cost down is for losers. 4. Not even the professionals can beat the market. 5. Advisors work for their firms, not us. 6. The industry only cares about our fees, not our performance. 7. No one can predict the markets. 8. We are paying expensive fees for poor performance. The bottom line is that the odds are stacked against us because the market makers always win. It is an insider's game. At the beginning of this presentation, I promised that I would lower your retirement age from 65 to 35 because hard work should be rewarded now rather than later. I just proved to you that the standard strategies of investing that we are accustomed to do not work. I do not know about you, but I am not happy about this, and I refuse to settle for less. How about you? The problem with winning the rat race is that we are still rats even if we win. Even the smartest money management technique is flawed on the basis of a lifetime of work for just a few years of fun. Most of us try to be smart about it by saving for retirement, paying ourselves first, putting money inside our 401ks and Roth IRAs, and then paying our bills. However, the issue with this strategy is that we are freezing our money now for a possible small reward in the future at the age of 65. But I believe there is a better way. Let me show it to you. Remember the 4% rule that does not work? Let's flip it on its head. See, the main issue with the 4% strategy and the false beliefs about compound interest are that these tactics are based on capital appreciation, the increase of the value of the principal over time. But in reality, we should be focusing on income production, on constant cash flow, not on market gambling, speculation. Basing our investment strategies on unlikely returns of more than 4, 5, or 6%, while at the same time eating away capital from the balance of our portfolio, we are sure to run out of money during retirement. Because the average income that the S&P produces over time is a mere 2%, forcing us to make principal reductions to the balances of our portfolios to pay for our living expenses. Let's imagine that to afford the lifestyle we deserve and want, we need only $5,000 a month or $60,000 a year. Under the typical asset allocation module, also known as the modern portfolio theory, By investing on the S&P, the initial amount of investment capital needed will amount to $3 million at a 2% dividend rate. At a 4% yield, the initial capital cost goes down to $1.5 million, and at 8% returns, we finally get our cost down to under $1 million. We can reduce the cost of our initial investment capital drastically because, under the old beliefs of investing in the plain markets, when you make a withdrawal, you are eating away your capital. Much like taking away a piece of cake and making the cake smaller and smaller over time until it is all gone. On the contrary, the strategy I am about to share with you is based on guaranteed income production of around 8%. That will work like a cloud dripping out income without reducing its size or eating away your capital. Now, we will create an income producing portfolio for life at a return rate of 8% so we never again fail to achieve our financial independence because this investment system I am about to share with you, it just works. How are we going to achieve this? Just as the professionals do, just as Warren Buffett invests with banks' preferred shares that will guarantee the constant income production of an average yield greater than 8%. Preferred shares are the sweet spot between common stocks and bonds. As you can see, they outperform the market and they simultaneously keep producing the free cash flow we are looking for. Where and how can we find preferred stocks yielding more than 8%? One of my favorite screening tools is the Preferred Share Scanner from the Wall Street Journal, a comprehensive list of all securities that can be sorted by yield. But why buy preferred shares? As I showed you earlier, Wall Street is an insider's game, and bankers never lose. So, instead of fighting against them, we should join them. We should play by their own rules. We should play the same invisible game they are playing around us, but against them. Take a look at the initial public offering term sheet of the following bank's preferred shares. Without getting into many details, look carefully at the document being displayed. These documents defined the conditions and guarantees of investment, how we will get our 8%. But what I want you to focus on is the bottom part of these pages, the listing of the book runners. Take a close look and see how they are playing the game. First, JP Morgan Chase uses Citigroup and Wells Fargo to do its business, while Citi uses JP Morgan and Wells to do theirs. Then, guess what Wells Fargo does? Yes, it uses Citi and JP Morgan services in return. It does not get more insider than this, but ask yourself this. Why would the biggest banks in America need help from their competitors to do business? Is there really a need for a preferred share capital structure if it is not to make money at the expense of other people's hard work? If this does not convince you, I do not know what will. Look at the traditional venture capital Series A, round terms sheet of investment. See how the venture capitalists structure their initial investment based on preferred stocks yielding, yeah, you guessed it, 8%. Do you notice a trend here? Can you see now how the invisible game is played around us? Wait, it gets better. Remember the financial crisis of 2008, during which some banks went bust and others, such as Merrill Lynch and Wachovia, got acquired? Well, guess what? Look at the bottom of the pages again. Yeah, the same relationships between Wells Fargo and Bank of America, now owners of the previously mentioned companies, still exists by booking the gains and responsibilities of their previously issued shares on the newly acquired companies. So, if one of the worst financial crises in history could not take down the idea of income investing on preferred. What will? Even Warren Buffett pressed the accelerator during the crisis by investing in this same strategy. Not only that, but the preferred structure was the strategy of choice for the government bailout, the TARP program. So, why would we not do the same? How can we not go wrong when we have Buffett, the banks, and even the government on our side? Now, the choice is in your hands. Are you going to wait until 65, or are you going to do something right now? When do you wish to retire? How do you want your portfolio to look? Like an old useless vehicle or a brand new high performance car? Ready for a change? Ready to improve your lifestyle? Allow me to introduce to you the Arbitrager investing system, a proven step by step system for income investing capable of doubling your investing performance in a single bank transaction, making your money do what it is supposed to do, work for you. The way that it works is by investing outside 401ks and IRAs. That way, you do not have to freeze your money for more than 30 years and pay high fees. With my strategy, your capital is free and accessible at any time, while simultaneously producing the income you want. The first strategy the system uses is the principle of capitalization and amortization. As you know, when we take out a loan, we pay interest on it, and over time, interest payments decrease. This is called amortization, much the same as a mortgage works. On the contrary, a certificate of deposit works the same way, but in reverse. Interest payments to you increase over time. They capitalize. Given the right spread differential between saving rates and borrowing cost at the end of the loan, we will make more money inside our CD than the money we pay out to the banks. With the arbitrager investing system, I will show you how. This strategy goes by many names, such as commercial interest arbitrage or interest rate arbitrage. But officially, it is called the net interest margin trade. Strategy so powerful and important that it is tracked by the Federal Reserve Bank of the government of the United States of America. That is because this is exactly how banks make most of their profits. And now, so can we. As I presented to you previously, under the old and useless way of investing, the modern portfolio theory, you will need 30 years and $3 million to retire at the old age of 65. But this is worthless. Let's do it right. What if I told you that you could reduce the initial investment capital you need to retire by more than half and then cut it in half again, making your retirement age 35 instead of 65, going from 30 years of investing to 15 years. Yes, it is possible, and this table proves it. By just investing under these conditions, you can cut your retirement age by more than half. And the best part of the arbitrager investing system is that it is interactive and customizable. On it, you will receive instant access to the same calculator being displayed, so you can customize it with your own numbers and investment needs. See how the cash flow compares with the classical approach of investing? Our strategy is based on income production, not speculation. See the outperformance of the sound investment principles of preferred shares investing, a method used by VCs, bankers, Warren Buffett, and even the government of the United States. Let's take a closer look at the real numbers. In 2014, to max out your 401k and IRA, a single investor will have a negative cash flow of $1,919.67. And worst of all, you cannot touch that money until you are 65 years old. That could cost you close to $20,000 in management fees, with investment returns of lower than 8% based on the old speculation model, the modern portfolio theory of diversification. But I know we can do better than this. In fact, much better. If you apply your capital to the arbitrage strategy, first, your money will never be frozen, and you can have access to it whenever you want, and not 30 years from now. Second, given the investment terms of a CD at 2%, a loan at 5%, and a preferred share yielding 8%, you will have a positive monthly cash flow of $172.68, producing free capital now so you can afford the lifestyle you deserve today. Unlike the 401k and IRA strategy that needs a lifetime to work in your favor, the arbitrager investing system will help you reap the rewards of all your hard work right now, rather than later. Which do you prefer? Pay the bank $2,000 a month for a chance to play later at the age 65, or have it pay you $200 now so you can enjoy the present without having to dream about the future. Inside the arbitrager investing system, I will take you by the hand and show you step by step how to achieve these financial returns. We will go from Module 1, describing how to raise investment capital, all the way to Module 4, where you will be able to create your very own income portfolio just as I did. This system includes practical examples and case studies with an interactive and customizable calculator, which will do all the hard math for you so you do not have to, thus meeting all your individual investment needs, conditions, and terms. In Module 1, you will learn the 7 ways to raise investment capital from scratch. Plus, you will learn how to adjust your tolerance for risk according to your personal profile. In Module 2, you will learn how to invest under a corporate structure in order to maximize your returns while simultaneously minimizing your taxes. In Module 3, you will learn how to invest like Buffett and pull the same exact $300 million trade he pulled on Bank of America and Goldman Sachs. Here you will learn how to beat the investment bankers at their own game. In Module 4, you will learn all the technicalities and fundamentals of investing, including tools and calculators that will do and adjust the math of the system to your own particular investment situation. From trading in complex investment instruments like ETFs, all the way to knowing how to operate on margin. I made this system so complete and comprehensive that there is no need to be an Einstein to understand it and execute it. It is simple and accurate, and it will help you afford the lifestyle you always dreamed of. Are you ready to take action now, or are you going to keep doing what you are doing? Are you ready to retire today and to start receiving all that passive income the smart way? Are you ready for the arbitrager investing system? Everything in life is a choice, and we are responsible for all our decisions and the results of our actions or inactions. The choice is yours. You can get a financial engineering degree yourself and expend the years and thousands of dollars needed to figure out the rest of this course by yourself. You can keep paying thousands of dollars for financial advisors and services that do not work and that freeze all your money for many, many years. You can also do nothing and keep expecting to achieve different results by yourself, trying to fill in the gaps you do not know yet. Or you can make a different choice. You can let me help you double your investment performance and help you retire now and not in 30 years. If you invest in the arbitrager system today, you will own everything you need to execute the same blueprint I used to create my very own income portfolio. Because I already have figured out everything for you, all you need to do is take action. The choice is yours. I am not a big fan of sports, but I am a huge fan of sportsmen. One of my all time favorites is Baby Ruth, not for his record of home runs, but for his action taking attitude. No matter the team, coach, playing field, fans, players, umpires, weather, or opposing team, he always called his own shots. He did not let others do what he needed to do himself. He always called his own shots. Are you going to start calling your own shots? Be brave, be bold, and be right. Invest in the arbitrager system and start calling your own shots today. Well, let me first thank you for your investment, attention, and your time, because for me, nothing is more valuable than time. Ergo, I did not want to wait until 65 to retire. I wanted to call my own shots. The arbitrager investing system is based on the same strategy I personally use to invest my own money in the markets. A strategy I developed to scratch my own itch for early retirement based on the sound math of financial engineering. If you choose to join me in my journey of smart income investing, I will welcome you with open arms and will guide you all the way through the system. By accessing the link arbitrageportfolio.net, you will have lifetime access to the arbitrage investing system and to me because I stand behind all of my strategies and systems, bearing all the risk and offering you a 100% money back guarantee. Yes, 100%. Check out the system, and if you do not love it, just ask me for your investment back. No questions asked. Again, that link is arbitrageportfolio.net for instant access. I will see you inside the system. And no matter what, from now on, remember to start calling your own shots.